Welcome to Money Matters TV. My name is Paul Mitchell. I'm a commercial banker. I'm your host for this show. Joining me is my co-host, Jim Mc Grory, CPA of Drucker and Scaccetti.
Yep, you got it.
Also known as the Tax Warriors.
You got it.
Which is appropriate because we're going to talk a little bit about taxes on this show.
Absolutely, Paul.
So, Jim, there have been many changes. The law took effect, was passed, I guess, in 2017. We're now in 2019. Lots of stuff's been written. A lot of changes occurred. Some results have already been seen. What are some perspectives you have on what's going on?
Well, Paul, as you mentioned, this tax law change was the largest tax law change in with 25, 30 years.
Wow.
So it is. We are seeing now a lot of the sort of the fallout or the results of the change. Mm-hmm. So one of the things you'll see this year is the doubling of the standard deduction. Mm-hmm. So many individuals can now take a deduction of $12,000.
I like that.
Where if they're married filing joint, mm-hmm. it's $24,000. So and many people are going to be not itemizing this year.
Right.
So in an effort
because you can't itemize as much as you used to be able to.
Well, it's so much exactly. So the side piece of that is that state and local income tax deductions and sales tax deductions and property tax deductions are all in total limited to $10,000. Mm-hmm. So where you're saying you can't itemize as much. Likewise, you can't take miscellaneous itemized deductions. Mm-hmm. So there's a lot of people that may have itemized before that are not going to be itemizing this year. Right. So that's a major change this year. Mm-hmm. From a business from a business side, we're seeing there is something called the qualified business income deduction mm-hmm. this year. So certain businesses can take a pass-through deduction, and you can get a 20%. Of your net income.
And that's where the word qualified comes in. You must,
correct.
Your business must qualify for that treatment.
That's correct. So there's certain businesses, and they're divided between service businesses and non-service businesses, mm-hmm. and there's different rules based upon your income, mm-hmm. whether or not you qualify for the deduction or not.
Mm-hmm. Have all these things been finalized? I heard that some regulations were still being written even a few months ago, and that maybe there's a question of even those that have been written, maybe they're going to be questioned or interpreted or things like that.
That's exactly the case, Paul. There was guidance. I'm going to say Congress pushed through this law very, very quickly. Mm-hmm. There were a lot of gaps and holes as far as what the true language should have been. Yes, like regulations have come out and some guidance have come out, mm-hmm. but there's still a lot of like missing pieces and a lot of questions left. So we're in the tax industry, we're just sort of holding on, saying is there going to be more guidance? Mm-hmm. Should we be mm-hmm. maybe extending returns this year and mm-hmm. not trying to finish things so quickly?
There's an interesting strategy. Yeah.
Because the guidance is still coming out. Mm-hmm. There have been tremendous changes, not only at the federal level, but the states have all been making changes. And in fact, just this week, Philadelphia came out with guidance as far as who should be subject to the business income receipts tax or not. So that's like just hot off the press.
Was that related to the federal tax law, or is that just incidental?
It's quite honestly, it's related to a Supreme Court case. It was in the Wayfair decision.
Oh yeah, sure, I've heard of that.
And so that was a sales tax case, mm-hmm. and it had to do with online retailers.
Right. And
there's this they're trying to come out with a bright line test as to what states should collect sales tax or not. Mm-hmm. Philadelphia is piggybacking on that decision. And they're basically saying if you have $100,000 of sales in the city, mm-hmm. you should be filing and paying BERT on your receipts.
Oh my gosh! So it's sales tax you got to collect. That's a pass through. But this other thing is you're based upon your income.
Right.
So maybe a business should be trying to pass along that as an additional cost of doing business, but
yeah, we'll see.
It's tough because their price then is going to be higher than the next state or something.
Exactly.
Wow.
Yeah, and again, it's so that we're waiting for federal guidance. Mm-hmm. The states are making changes all the time, and now the cities sort of jumping on the train.
Wow. Yeah. Wow. So small businesses generally are not as heavily impacted as larger businesses by most of these changes?
Well, I wouldn't. So another change, Paul, that may impact smaller businesses was there's a business interest expense limitation that if you look at the initial guidance, they're saying that businesses under 25 million should be exempt from these limitations.
Yep.
However, there's devil in the details. If you have losses and you are in a partnership and more than 35% of your losses gets allocated to your limited partners, you're deemed to be a tax shelter, which is a name you haven't really seen since the 80s.
Yeah.
So, and if you're deemed to be a tax shelter, your business interest expense could be limited. So even though you're a small business, you may not get the full impact of your interest expense deduction.
Yeah. Wow.
Yeah.
So what are you advising your small businesses generally to do these days?
Some of the good things that came out of the new law were there was increases in the amount of asset write-offs you could take. So the 179, which is an instant expensing of business asset purchases, that was increased from $500,000 to $1 million. Now a lot of small businesses that they won't get to that level of purchases, but I would recommend they look for these ways to accelerate deductions. All the while they have to keep in mind that they can get that 20% QBI deduction, the qualified business income deduction, possibly. So it's a fine balance. Don't deduct too many expenses that you won't benefit from the 20% qualified business income limitation deduction. So qualified business income.
But whatever you do or don't do this year, you could not do or do next year. I mean, you can. Things are ongoing. It's not just a one shot type of deal.
Correct. Yeah, there are certain elections you can make that may be permanent. That has to do with real estate people in the real estate industry. Some of the recent guidance was that people who have rental properties, if they meet certain safe harbors, they can take the QBI deduction, the qualified business income deduction. There's a grouping election that if you do make the grouping election, it's a permanent election. So you do need to watch. So there are, I would recommend clients, if there's gray areas, really don't rush to get your tax return done on time. As long as you have your taxes paid in by the due date, you're fine. You'll get an extension. And you could, if more guidance comes out, if more of the dust settles, then you can make better decisions later.
Yeah. Would Eddie, would it be a great impact on in Philadelphia area? There's been so much development of old properties and building new properties and that type of thing. Is there any specific applications there that people should be thinking of?
So another good benefit that came out of the tax law change was something called a qualified opportunity zone. That gives individuals with capital gains the opportunity to reinvest in qualified opportunity funds, and to some extent you could eliminate some of your capital gain. And also, if you're in the fund long enough, you can basically make any of the appreciation in the fund completely be eliminated.
It sounds like something you should talk over with your tax advisor or investment professionals and that type of thing.
Absolutely.
It's kind of new and a little different, a little out of the way.
Exactly, because it's a long-term deferral.
Yeah. Jim, we've got a question from one of our viewers.
Okay.
And the question is from Edward Thomas of Philadelphia. And he asks, could you give some tips for getting tax forms in good order for this tax season?
It's a very good question, and I think the best thing to do is to be organized. If you make sure you get all of your W-2s in order, from any of the jobs you have. If you have any 1099s from jobs, make sure you gather all that. Take a look at what you had last year and make sure you're getting it this year. If you have any 1099s from your interest accounts, bank accounts, brokerage accounts, make sure you get those. Make sure that if you made any charitable contributions, in excess of $250, you want to make sure you get thank you letters that document that you made that contribution. And the best thing, if you have a small business, absolutely use a software package or whatever you can to get your business records in order.
Terrific, Jim.
I'd also, make sure that you, if you can, maximize your retirement contributions. If there's IRA contributions you can make or 401k contributions, try to maximize those. That's important, and I think it's oftentimes forgotten about that. And then the third thing I would do is make sure that you consider bunching your deductions. We talked a little bit about the itemized deductions being limited this year, but you can basically strategize to put certain deductions, like this year, that you'll take your itemized, and then next year you'll take your standard deductions.
Right.
So that by bunching, you'll get the benefit.
I know what you mean by bunching.
Yeah.
That's good strategy.
Yeah.
Thanks, Jim. Some good tips for our viewers. Thank you very much.
You're welcome.
And if other viewers would like to send a question into Money Matters, here's how you do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Now we come to the part of our show where we introduce our featured guest. Our featured guest for this show is Jeff Savlov of Blum Savlov. Financial advisors, I believe.
Nope, a little bit different, but I will definitely fill in the blanks for you.
Great. Jeff, tell us about
Take it away.
What your profession is.
There's no easy name for what I do, so I'll try to be succinct,
Okay.
but your patience will be appreciated. It's a little tricky, and I can see why you might say financial advisors, but basically, I have a niche consulting practice where I work with families who have accumulated significant wealth, and I help them to ensure that that wealth serves current and future generations in healthy and productive ways. That's kind of a general overview. I'll be a little more specific. I work with families who have operating businesses. Maybe it's parents in the first generation looking to transition it to the second generation or involve them. Maybe it's third, fourth, and fifth generation all working together with people living longer. You can get third, fourth, and fifth generation in at the same time, and a lot of issues can arise from that. I work with families who have legacy wealth. Maybe they had an operating business at one point, sold it, and now they share other things, no business, but real estate, investments, trusts, a foundation. And then the third area I specialize in, which is newer and really exciting for me, is coaching parents in these multi-generational contexts of wealth before they even have kids. So really couples, they're not even parents yet. Couples before they have kids, and parents during the first few years of life. Obviously, you're not going to take out, banking statements and show them to a 2-year-old, but it's about getting the parents on the same page. What does it mean to have this kind of wealth? How do we want it to affect our kids? And how do we parent so that we'll have the kind of kids who can be responsible in that environment? Quick overview of my background. I come from a family business. I worked in commercial printing in New York City with my dad, who was a wild guy, and it was a wild ride, and all of that, and the fact that I wasn't interested in commercial printing. I went on my own, and my parents were enlightened about that. Find what you want and go do it. Sometimes you see in family business pushing kids to come into a business when they don't want to be there, or allowing kids into a family business who have no reason being there. My parents said, figure out what you want to do and do it. I left, I went into sales and marketing. It was important for me to see what I could do in the world on my own, got my own job, did my own thing, was really successful, and realized that it was really people that interested me and families and the way that they work in groups. Went back to grad school, studied group dynamics and family dynamics, got trained as a family therapist and a psychoanalyst.
I was going to ask what qualified you to advise families on how to raise their children.
And that puts it all together. So I have family business experience firsthand, I have non-family corporate experience, and then a whole bunch of training in psychology and family dynamics. And I really work at the intersection of family dynamics and emotion and relationships, where it intersects with shared leadership and ownership and management of stuff.
Complex.
Pretty awesome.
Hope that was as succinct as possible.
I got you.
Jeff, you mentioned coaching parents on teaching children about wealth. I mean,
Yep.
how does that work? What do you do?
So at the earliest ages, and this is true for parents of any income level, there's some basic things you want to do, but what makes it different is when there's significant wealth, there's a safety net that can be harmful to your child. What children need to develop self-esteem and character and grit, is to have difficulties and to surmount them. If you make life too easy on a child, they don't learn to have that kind of grit and resilience. And so it's important for all parents to do what I'm going to talk about, but especially when there's that safety net, and to get in your head the idea that you don't want to make it as easy as you can make it. And that's especially difficult when parents maybe came from tough, humble beginnings, worked really hard to create wealth, and then they're saying, hey, I don't want my kids to go through that. Their heart's in the right place. But then you can make it too easy, and they don't learn how to really fend for themselves and to how to go out there and make their own way. So to be more specific, some of the things I talk about are, and this is with parents who or couples that don't even have kids yet or have really young kids, please, thank you, I'm sorry, and the golden sippy cup rule. Please, to teach kids to say please is about respect. Thank you is about gratitude. When someone gives you something, to express gratitude. I'm sorry is about remorse, that your behavior can affect other people, and that it's important to be able to apologize when you do that. Just basic character building. And the golden sippy cup rule is, when there's significant wealth, there's often nannies and other caretakers around that can do a lot for the child. It's important that they don't. And so as soon as a child can hold their little sippy cup and drink from it themselves, they should be expected to take that cup when it's empty, not just leave it for someone else to pick up, to carry it over to the sink or the dishwasher and put it in. Those are really basic things. You're thinking, what does that have to do with running a business? Well, if you think about it, if you don't do those things, you can have a child who's more selfish, entitled, wants other people to do things for them, instead of saying, hey, this is the family business, I want to do my part, I want to earn my way. That's how the world works. You teach a child how the world works in those earliest years.
Another thing I've seen, which seems to me to make sense, is that the child, when they, let's say they graduate from college or something, instead of going directly into the family business, they go out in some other business on their own for at least a period of time. Maybe they don't want to go in the family business, et cetera, but at least they had that perspective of doing something else, and then making a decision of, well, I could do this, or that, and one of those things is going into the family business, which mom and dad probably would like me to.
Often, yeah. No, that's great. And in the family world, I agree with you. I personally, based on my experience, think that's a great thing to do. Before you go into the family business, go prove yourself. And I work with families on policies about how you enter the family business, especially after the first and second generation. Families grow exponentially. That third and fourth generation, you can have 20, 25 cousins that are all looking to get in. So I help families come up with policies of how do you get into the family business. And there are families who say you have to go to college and get a degree, and then you have to work somewhere else for several years, and then you can come and only work up until this level, then you got to get an MBA and maybe go somewhere and get a promotion at another firm to really come back. And other families are much more loose about it. The looser you are, the more dangerous it becomes for that dynamic of family and business going forward. But there's also a conflict among many family business owners. Some feel like, I want my kid to go to college, but then I want them, these are my resource, I want them in the business, I don't want them somewhere else. And I think there's a trade-off there, because the child can lose, because they're always going to wonder, no matter how far they get, what position they're in, am I here because mom and dad put me here? So there's something, I think, in the child's interest. Go and prove yourself, like I did with my business, my family's business. I wanted to know what I was capable of without dad giving me anything. And believe me, he wasn't handing me anything. I was sweeping floors for way too long, but really starting at the bottom. So there's a couple ways of looking at that. And there's, I'd say about 50% of the families I work with, they really want the kids to come right back in. And it's hard to see the advantages for the child and the business of having that other experience.
I sometimes see with clients, Jeff, that a high net worth individual will only want their children to know enough about the financial world of the family. Do you find that? Do you find like families, like it very difficult to talk about the family wealth?
To get specific, that families get kind of nervous about it. I do something called the Purposeful Legacy Family Project. I've done it with children as young as 8 years old in the room. And look, I work with parents that are in their 90s and kids who are in their 60s, but I really like elementary school age, 5, 6, 8. middle school and high school, and when parents even hear about this, when someone refers them to me and they're like, what are you going to do, sit down and tell my kids how much money we have? And the truth is, there's a ton of things we could be talking about, and you as parents should be talking about, that have nothing to do with money.
Right.
How did the business start? Where did the wealth come from? In every family I've ever worked with, somebody struggled and took risks and had failures before they had successes. The kids need to know about that. They need to know who the family members were, how hard they struggled, the risks they took, the failures they had, and then the upside of how it all came to be. So there's a context. This stuff doesn't come out of nowhere. So family stories, talking about values. We value education. It's important to us, whatever you do with your life, that you get good grades, and encourage kids and hold their feet to the fire to get good grades. Some families, I've worked with extremely wealthy families who demand that their kids get a job and pay for their part of their cell phone or other things, even though the family could easily afford it. Crucial. So there's a lot you could be talking about that has nothing to do with money. Then, developmentally, as the kids get older, you can bring more of the money in. And when parents come to me for that kind of a workshop and at first are terrified and they realize we're not going to talk about money, within 6 months they're ready to have these mature, when they're ready and mature and responsible, young men and women, they're happy to start to show some of the details because they see that the foundation is there and they can see that.
I certainly appreciate your field, because as a commercial banker, I've financed a lot of family-owned businesses and that type of thing.
Yeah.
And
so you've seen a lot.
Yeah, and there have been some disasters. You found out after the fact. 12 family members at this 45-employee business, and 2/3 of them, let's say, shouldn't have been there. Were incompetent enough, or whatever you want to call it. And they all have different last names. You don't know. So guess what? We kind of, where I've gone, we kind of make it a policy to dig in and try to find that out ahead of time. I mean, it may be okay. They may all be competent. We want to know the difference and not have to find out the hard way.
And if those 12 family members are all competent, it's because somebody along the way said, we need to really make sure that we're going to take family members because there's a job for them that they can do, and they can do it well. Not this idea of fairness. I've seen real, and not just sort of mom and pop level. A lot of my clients are large, and in billion-dollar companies, I've seen, well, the oldest male is going to be the CEO regardless of his ability. You were born first and are a male, you will be the CEO. And that doesn't mean just being born first doesn't give you any special DNA that makes you a CEO, but people still do that, and businesses can be crushed by something so arbitrary. So the families that make it and have 12 relatives working there who all are contributing well, somebody along the way said, we've got to be formal about this. We've got to make sense we're taking care of the business and the family.
So I'm guessing that with the competent, incompetent, I mean, do you see clients like families like in conflict, like a lot of conflict? Is this what you're seeing in your world?
Yeah, that when I tell people what I do for a living, they go, hey, tell me stories about fighting families. They want the juicy, Dallas, JR and all that stuff. I'd say 10 years ago and prior to that, even up to as recent as 5 years ago, most of my stuff had some level of conflict. And conflict's normal in a family, so there's nothing abnormal, it's how you manage it. But intense conflict was more frequent in the past. Now, this whole field I'm in, there's a lot of education going on, there's a lot of organizations for families. Families are getting educated, and they're starting to come to me when things are great. Just had a family couple come to me, they've got 3 kids, their restaurants bring in, 40, 50 million in revenues, their 3 kids work there, everything's fine, and the kids are still at the lower levels, and they said, can you just help us keep it that way? And that is a pleasure. It takes a lot less time for me, it costs them a lot less in terms of my services because things are going well. It's a lot easier to keep them that way than to try to unravel a big family mess.
Absolutely. So what are some of the common challenges for these families?
It's a lot of the stuff that we talked about already. I mean, you're talking about often an ownership group is people who happen to be born from the same, cousins. Cousins in the 3rd generation had kids. Okay, now you got the 4th generation. We were born from people who are related. Now we're in the business. That's not the way most companies form an ownership group or their executive team. So it's really tricky to tell some people you can come in and some family members you can't come in. To make those kinds of decisions, families really struggle. And so like I said before, sometimes everybody comes in and they try that and that doesn't work, and eventually the ones that survive will come around and find other ways of doing that.
Could you give us an example, not mention names of course, but just an example of you came into a situation and how you work with it and what the I'll say, I guess the positive outcome, or maybe they had some negative
Yeah.
outcomes that they said, we've had enough of you, Jeff, we don't need you anymore. And
Yeah. So there was a situation where 3 siblings were given, they were each given a third of the business and the same salary. The firstborn male was president and worked there for many years and was competent and really worked his way up. The secondborn was a male brother and had a lot of emotional issues, learning problems all the way through school, and this was almost like sort of charity to him. This is how we're going to take care of him. But he was given the same amount of ownership and salary, and he wasn't carrying his weight. And the third was a daughter who went to school to be a teacher, and that's where she wanted to be. And Dad said, no, you need to stop teaching. We need you in the family business. What's interesting here is what wound up happening is it came out that the middle son had emotional issues, learning problems all through school, and parents hoped that they would go away. It was actually a relief, to give you a quick synopsis, a relief to him for this to come out and for him to say, this is not the right place for me. I feel like I'm doing it because Dad wants me to, but I feel like I can't do my part. You guys are angry with me. Help me find a way out. So the brother and the sister came together as siblings and helped him explore all they kept paying him while he went out to find something that made sense for him. And without being too long-winded, there was actually something, he was really good with his hands. There was an opportunity for their firm to do something that was very mechanical as a new kind of direction, and he was great at it. So they found something that worked for him. He didn't have to be the senior VP of whatever.
But without having you facilitating it, this conversation would never have happened.
When I first came in and met the president, he said, I didn't know what else to do. I'm glad we found you. I was about to take my brother in a room and just start punching him in the face.
Oh, gosh.
I said, I don't think that was going to work so well. But that's where he was at. So it gets sad. It gets tough.
Well, that's true. I've never really kind of heard the field before. I mean, I've heard the issue before and that type of thing. But it's usually more of a, I don't know, either a total psychologist type of thing, or somebody belongs to a business association, can talk to a fellow CEO or something like that, about their personal family issues, but trying to keep it under wraps a lot. So getting it more to the surface sounds like it can be a very
we don't want to
helpful
talk
thing.
about family problems.
There's a whole field. The Family Firm Institute is an organization for professionals to get trained. There's places for families. There's a lot going on.
Terrific subject. Thanks, Jeff, for coming on the show.
Thanks.
Learned a lot.
Yeah.
And our next guest will be George Cairns, who's chairman of MCC Worldwide. That sounds like the big time to me. So remember, on this show, your money matters.